This is not new. We've seen this before. GBTC was the perfect analogy.
In today's video, Mark Yusko, the founder, CEO and CIO of Morgan Creek Capital Management, discussed about the Fed raising interest rates and impact on all markets including crypto, the crypto bear market, and if we've hit the bottom on Bitcoin.
You talked about this sort of, I don't want to even call it immaturity, but I'll call it the immaturity of the investors in the Bitcoin and crypto space. Do you think that as the stamp of approval effectively has come from Larry Fink and BlackRock and institutions and smart money and real professional traders are coming in, do you think that that's going to change the dynamic of how the price action moves because there's going to be a little bit more maturity coming into the space? Or do you think it's going to move in parity with, as those new people come in, also the awareness of Bitcoin and crypto is going to exponentially grow? So we're still going to bring in a lot of people that have no idea what's going on either. Like, how do you contend with the change once institutions are involved?
Look, it's a fantastic question. And it kind of goes to the heart of where we are in this evolution of the cycle and of the technology. So if you think about how every technology comes into being, they all follow an S curve, right? So it looks like a big letter S, and the first 10% come in over the first decade. Then the next 80% come in over the next decade, and then it matures over the last decade. And you go from, the originators to the early adopters to the early majority, and then you have this inflection point. And I think we're about at that inflection point, because the first 4 years, I don't really count them because it was kind of a science experiment and there was like 7 people involved, and last 10 years, it's real. And
right.
So
especially this whole last cycle too. Yeah.
Yeah. Yeah. And so we're at that inflection point, and yes, institutions theoretically are better decision makers than retail individuals. The problem is a lot of institutions suffer the same problem because they're run by small groups of humans. Yeah. And those groups tend to make equally bad decisions. The pension funds in particular have a long history of being just as bad as individual investors. So I don't know that the institutional money coming in is going to be quite the panacea that everybody thinks. The thing I think is interesting is...
I got to pause you there for just 1 second, just because this came into my mind, and I think you'd be the best person to ask this. A lot of people that I talk to are also wondering, along with institutions, if they're so traditionally long time horizon investors, is there going to be a weird sort of dynamic of trying to figure, especially because this is an emerging market, are they still going to be long time horizon investors, or are they going to be hedging and taking percentages? Like, are they going to be trying to buy near bottoms or, a confirmed start of a bull market and starting to, to level, layer out near a top, effectively potentially truncating an exponential growth cycle? Or them being involved, it's kind of a perplexing.
Again, another good question that's complex in the sense that not all institutions are the same, right? There are long duration investors like endowments, foundations, some pension plans. There are shorter duration institutions. I mean, BlackRock would be that, right? An ETF is not a long-term investor, right? It's a daily liquid, tick by tick liquid asset that the institution, BlackRock, doesn't make the decision. It's the masses come in, the masses go out, assets go in. Look at ARK, right? It can go, lots of money can go in, lots of money can come out. Now, the scary thing to me is despite losing more money than she made, more money still going in to that ETF. So I don't really understand that. But the institutions are very varied. And if institutions like Citadel, right, which are the ultimate high frequency traders and day traders, come in, they have a fractional of a second hold period versus, Yale might say, I want to hold this for 10 years, or, I might say I want to hold this for a decade in my venture capital fund, which we do. So Very different. And the other thing that I think is interesting is this is not new. We've seen this before. GBTC was the perfect analogy. We know what happens when a institution, right? GBTC was a Cayman trust. That is a institutional pool funded with all of this other individual retail money. Now, it couldn't be retail at first because you had to be a qualified purchaser, and then qualified investor, and then you had to buy it in the private markets. But then a year later, you could sell. So then people could trade it in their PA. Well, what happened? We hit the $10,000 fair value, and then we went ballistic. I mean, we went straight up. Yeah. And everybody's like, oh, that was Michael Saylor and this. No, that was GBTC getting bought every day. Their asset base went from nothing, literally nothing, to I think 20 plus billion at the peak. And the thing about people forget is when the asset was 200 billion, and 20 billion comes in, you're like, oh, that's not that much. No, it wasn't 200 billion. At least 150 billion of that 200 billion was never going to move. It was the lost or stolen and the stranded and the hodlers and the people who are still accumulating. It was maybe 50 billion of free float, 20 billion on 50. That's going to put some serious pressure. Now we got this again. We got a $500 billion asset, and 100 billion of it is probably the free float. We're talking about 30 billion. If 0.1% of the 30 trillion of assets that are engaged in ETFs is, according to Eric Balkunis, who's an interesting analyst, 30 billion on 100, that'll move the price. But what if he's wrong? What if it's 1%? What if advisors like, I have an advisor and I haven't been allowed because, UBS doesn't allow you to own anything crypto related. When this thing gets approved and it's a BlackRock fund, they're going to have to let it be approved. They're not going to be able to say no longer. And then I'm going to put at least 1%. And if everybody puts 1%, now you're talking 300 billion on 100 billion of free float. That'll move price a lot. So, but the other part of your question that's really, really insightful is those institutions also hedge. So we've seen that, right? When the futures ETF was released 2 years ago, prices started to go down. Well, wait a minute. I thought people were buying Bitcoin.
Yeah.
No, they weren't. They were buying paper representations of what could have been a Bitcoin, but there was no physical demand for spot. And the big banks were shorting, which is what they do in futures markets where there's the ability to create paper goods. Oil markets, gold markets, silver markets, palladium markets, all these markets have an element of manipulation, which is the word that, Chairman Gensler likes to focus on. Like, dude, you think the crypto market or Bitcoin market is manipulated? Have you looked at the triple leveraged VIX ETF lately? You want to talk about manipulation, or the ETNs that trade in agricultural futures or gold? GLD has been spoofed for years.
Do you truly think that is there any water or weight in the comments around the fear of spot ETFs causing manipulation in the market? Is that more or less than the potential from a futures ETF?
Yeah, well, I think far less than from futures, right? I will argue the futures ETF, it's not a coincidence that November 6th, the day of the release of BITO, was the day of the peak of the market in 2021. That's not a coincidence. What futures markets allow you to do is they allow you to create commodities out of thin air. In the old days, if I had a barrel of oil and I wanted to sell to you, Kelly, I would actually have to have the oil, and I'd have to have the capacity to put it on a truck and send it to you before I could take the money. That was an oil transaction. And then someone said, well, but we have these electronic ways to represent physical things. We don't have to have analog anymore. I mean, think about, last week I went to the Foreigner concert. And when I was in college, I had the original Foreigner album, record, vinyl disc. And Lucky Rodriguez just didn't give it back to me. So wherever Lucky is someday, I heard he was San Antonio or whatever, he's got my Foreigner album and I want it back. But we migrated from albums to electronic. And, for a while, I would have my, electronic copy of Foreigner, Feels Like the First Time, their first song. And I would make a copy on my computer and I'd send it to you through a, file sharing app. And you were happy, I was happy, but the music industry was very unhappy because they wanted you to buy your own, copy. And so now we have digital music. And so I can't copy and send. We all stream from controlled content, and the royalties get paid and the fees get paid, and the writers who wrote the songs actually get paid. So the world is a better place, but we have to pay our share. And so now with money, we have this ability to do the same thing. And the bearer assets come with risks. Right? Think about physical pieces of paper. They can get lost. They can get stolen. They can get burned up in a fire. Money, well, one, it's the root of all evil, but two, it's the source of all power. And it's really currency, not money. Money is a very unique thing, right? Money is an asset that exists in the absence of a liability. And there's really only one in the world, and that's gold. And it's been that for 5,000 years. And there have been other things that have tried to do it, from little shells to stone tablets, but gold, persevered for 5,000 years. And everything else that we think of as money is currency. Well, currency is not really money, because currency has a liability associated with it. There's debt behind currency. And governments like currencies because they can issue them by fiat, right, by decree. And when you can do that, then you control things. And if you can buy up all the goods, this is the crazy part, right? This is called the Dictator Playbook 101. Yeah. So if you look at the history of dictatorships and empires, they all end the same way. You get a small number of people in charge at the top that own all the assets, right? They buy up all the assets. And then they devalue the currency, which basically steals the wealth from the bottom and concentrates it at the top, right? The Zimbabwe Stock Exchange was the best performing stock exchange in 2007, 8, and 9. I have a 100 trillion Zimbabwe dollar bill over there on my desk that wouldn't buy a loaf of bread. You look at what happened in Venezuela with the Bolivar. I actually have a piece of art out there where if you put an app on it, it's actually made with bolivars that are worthless. And they light on fire and Bitcoin pops up behind it as their savior for Venezuela. Because if you exchanged those bolivars for Bitcoin, as the bolivar went to zero, your wealth didn't evaporate. Look at what just happened in Argentina today. They devalued the currency and stole everybody's wealth again. Had you converted those pesos into Bitcoin. And here's the ultimate thing about Bitcoin. One Bitcoin is one Bitcoin. But we don't price it in Bitcoin.